Hello everyone, how are you? I hope all of you are doing really good. So welcome to another session, and in this session we are going to take up our topic, that is budgeting and budgetary control. So practically, if I talk about, this is one of the simplest topics because there is nothing new to understand. The only thing is the basic things you need to apply, or whatever we have understood as of now, you have to apply that only. That's it. What is a budget? The budget is the future planning based on the past experiences. Why do companies prepare budget? Every company prepares the budget. Why, sir? Why the companies need to prepare the budget? Because they want to compare their planning with whatever the actual results are, right? And then they try to find out if there are any variations that we have studied in the standard costing, and in case there are variations, they need to find out the reasons for that variation and take the corrective action. That is the main purpose of what this budgetary chapter, right? That we plan for the future, the upcoming future, we plan for it. Okay, we are planning that this should be the profit. We are planning this many units we will be selling. We are planning that this many units we should be manufacturing in the upcoming year, depending upon the demand that we are forecasting, the demand that might be there in the market in the next 1 year, 6 months or whatever, right? Now, from the examination point of view, because here we are going to talk it to the point, to the examination point of view, the important budgets are, important budgets from examination point of view, right? The first one is the flexible budget, right? What is a flexible budget? Then second is the sale budget. Then we have the production budget. Then we have this raw material budget, raw material consumption and purchase. When we talk about raw material, there can be two types of budget. One is the raw material consumption, that means how much of the raw material is going to get consumed, and second thing is purchase of raw material. So two types of budgets can be there, right? Then important is your master budget, right? Little bit importance can be given to cash budget also, cash budget, right? Rest, if you talk about the other topics, other important topics, one topic that is important here is the ratios, right? Ratios are important, the budget ratios, that is simple, sir, right? Second topic from theoretical point of view that is important from this chapter is zero-based budgeting. Zero-based budgeting. In this chapter also, if you know everything that you have studied in the cost accounting, the basic concepts are clear, then whatever is the information that is provided in the question, you have to work on that information. That's it, right? And one budget is dependent upon another budget. Okay, sir, let's see. So what is a budget? A budget is a financial or the quantitative statement prepared and approved to a defined period of time of the policy to be pursued during that period for the purpose of attaining a given objective. This period is what? This is the future period that we are talking about, that planning for the future. It may include the income, expenditure, the employment of capital, anything can be included in it, right? Characteristics of the budget: it is prepared in advance. That is why we are saying that budget is being prepared for future. It relates to future expressed in the quantitative or the financial terms, in the numerical terms we call it, whether in terms of quantity, whether in terms of value, but it should be a numerical thing. Next is the meaning of budgetary control. What is budgetary control? That, sir, if there are any variations in the budget or in the planning that we have done, we need to understand those variances, create the new budgets according to the results, right? So develop the budget, actual and budget, analyze the difference between actual and budget, take the corrective action and modify the future plans. This is what is known as budgetary control. These are the activities which are involved in the budgetary control, right? Then classification of budgets are there. The first one is the fixed and the flexible budget. What is a fixed budget, sir? The fixed budget is the one which does not change with the level of activity. Today, you are manufacturing 10,000 units. Now, tomorrow you are planning to manufacture 20,000 units, but you say the cost, which we have set for 10,000 units, it should remain same for 20,000 units. Is it possible? Is it possible, sir? Practically it is not possible. So fixed budget is practically not used. A fixed budget is a budget designed to remain unchanged irrespective of the level of activity actually attained. What is a flexible budget? The flexible budget says, today if you are manufacturing 10,000 units, right? Tomorrow you want to manufacture, you are planning to manufacture 20,000 units. So what will happen, sir? In this case, he says the cost will change, especially if the direct material cost, let's say here it is 1,000, here it will increase to 2,000, sir. The variable cost will change, na, sir, according to the level of activity. So accordingly, when you are making the planning for 20,000 units, you will take up the cost according to that. You are flexible with regard to what? The flexibility is in regard to that you increase the number of units, your cost will also change. The fixed cost might remain same. Yes, the fixed cost will remain same. The variable cost at least will change, sir. Sale units will change, selling price per unit may remain the same, sales value will change, all the variable cost will change. So all these things you need to incorporate. Right now, here if you are preparing the budget for 20,000 units, your material cost will be 2,000. Now what actually happens? Is, let's say the cost is 2,000. So that means there is no variance. But in case of the fixed budget, they say you have to compare it with this only. Sir, is it comparable? Is it comparable? The actuals are for 20,000 units. And the budget is set for 10,000 unit. The fixed budget says that compare this 1,000 with this 2,000 rupees. Is it comparable? Can you say that this variance, there is a 1,000 rupees variance, adverse variance? We cannot say that. Even in the standard costing we have studied, that is why we calculate standard quantity for actual output. This is the reason. Clear? I hope this is clear. So that is why the flexible budget is more practical, that be flexible for the number of units that you are going to manufacture, right? So that is a flexible budget. This is the format of flexible budget, that at various percentage of the capacity, at 60% capacity you are manufacturing 6,000 units, at 80% capacity you will manufacture 8,000 units, here you will manufacture 9,000 units. So if your number of units are going to change, obviously sir, your cost is also going to change, especially the variable part of the cost is definitely going to change, because that is what we say, that variable cost is dependent upon what? It is dependent upon the number of units, isn't it? We are saying, na sir, that it is dependent upon the number of units, so it will change. Why not? The fixed cost might not change, right? So variable cost of sales, contribution, fixed cost will remain same at all the levels of activity at 60% until and unless the question otherwise mentions. If the question specifically says that there is an increase in the fixed cost beyond 80% level, so at 90% level you will increase the fixed cost also. There can be, right? So you will get the profit. This is the simple flexible budget. The questions can be asked. Yes sir, the questions can be asked. There is no doubt about that. The questions can be asked, sir. Next is the sales budget. Now what does the sales budget tells us? The sales budget tells us about the various things, that how many units we want to sell, at what price we want to sell those units, right? In which area we want to sell the units more, in which quarter of the year or in which particular period of the year we want to sell more number of units. That is what we will get from the sales budget. Clear? Now, dependent upon the sales, you will prepare what? Production budget. You will produce the goods dependent upon the demand. Demand means the sales, isn't it? Now, let's say the sales budget says there is a particular product X. For this particular product X, you have prepared a sales budget. The sales according to the sales budget is 10,000 units. So that means if you want to sell 10,000 units, you will have to manufacture 10,000 units now. Yes sir. So what will be units produced, right, and sold? 10,000 units. But at the same time the company says that sir, we want to keep some extra units as a closing stock, so that in case there is some other demand, Okay sir, if you want to keep beyond this 10,000, besides this 10,000, if you want to keep some extra units in the stock as a safety stock, that also you will have to manufacture. Add closing stock. Add closing stock, that is 5,000 units. Now you will have to manufacture total 15,000 units. But when the store manager went to the store and checked there now, there was already an opening stock, sir. He said, sir, there is already an opening stock of 2,000 units which is lying in the godown. So we say, okay, we will now manufacture only 13,000 units, right? Clear, sir? So this is your what? This is your production budget. That is what is there. The budgeted sales, right? Add closing stock of FG less opening stock of FG. That will give you the budgeted production. Simple. Now, if you talk about raw material, sir, raw material consumption will be dependent upon what? The raw material consumption will be dependent upon this production. Now, let's say, if I say that raw material consumption per unit, raw material consumption per unit of finished good, that is in the manufacturing of 1 unit of finished product, how much of the raw material is utilized? That is 2 kg. Now, how many units of the finished product I am going to manufacture? This I have decided in the production budget. Just 13,000 units I have decided. So what will be the raw material consumption? What will be the raw material consumption, sir? The raw material consumption will be 13,000 multiplied by 2, that is 26,000 kg, isn't it? Now if I ask you that, sir, how much of the raw material needs to be purchased? Sir, if you are going to consume this 26,000 kg of raw material, then obviously you are going to purchase it, na? Only then you will consume it if you are going to purchase it. Okay. 26,000 is going to be your purchases, but at the same time the company says we want to keep some extra stock of raw material for the safety purposes. Okay sir, agreed. Add closing stock of raw material, right? How much? 5,000 kg. The company says we want to keep it extra. So how much they will have to purchase? Now they will have to purchase 31,000 kg of raw material, isn't it? 26,000 is going to get consumed, sir, already going to get consumed. Extra stock they want to keep, that is 5,000 kg. So total 31,000 kg of the raw material they want to have. Now the store manager again went to the store. He says, sir, wait. He says, sir, 3,000 kg of the raw material is already lying in the store, sir. Okay, so if already some material is available, that is opening stock of raw material, he says, sir, 3,000 is already available. So how much of the raw material is to be purchased? RM to be purchased. How much of, sir? 31 minus 3, that is 28,000 kg. Clear? This will be the raw material purchase. This is the quantity that we have find out multiplied by the rate. Let's say the rate is 1 rupee. So RM purchases in value terms. RM purchases in rupee terms, that is 28,000. Any doubts in this thing? Clear? RM consumption, add closing stock of RM. So material consumption is dependent upon the production budget. Production budget is dependent upon what? The sales budget. Right? So the budgets are interlinked, sir. Direct material purchase budget, we have discussed, sir. Total usage, right? Budgeted total usage, add closing stock minus opening stock, purchases multiplied by rate, budgeted purchases, sir. Now coming to the direct labor one, this is simple, sir. Which type of a labor is going to be used? If you are manufacturing more than one product, in the making of those products, how many labor hours will be used? What will be the rate for that? That is based on the direct labor cost budget, right? Department P, product A, number of hours, what is the rate? Department Q, product A, product B, how many hours, what is going to be the rate and amount, right? R and S. Clear? That is simple. Now factory overheads budget. What is factory overheads budget, sir? all the budgets which are related to the factory overheads. Variable cost is there, spoilage, indirect material, printing stationery, postage, telegram, semi-variable repairs and maintenance, light, heat, power, water, telephone, fixed cost. Sir, everything will be given in the question, nothing to worry as such, right? Production cost budget we know, sir. Production cost budget we know, sir. Material, labor, expenses, prime cost, add production overheads, production cost. Simple from the cost sheet only. Then we have the ending inventory budget, no need to do it that much. Cost of goods sold budget, we already know from the cost sheet, sir. Again, the cost sheet part that we are preparing here. The cost sheet till the cost of goods sold after the adjustment of opening and closing finished goods. The same as we prepare the cost sheet, right? After that, administrative cost budget, nothing, you just have to identify what are the cost, the administrative cost which is there. Selling and distribution cost, again nothing much is there, just read it once. Research and development cost, just read it. Capital expenditure budget, that during which period, how much of the capital expenditure budget we are planning to do. Cash budget is basically what? The cash budget is related to the cash receipts and the payments, right? Total cash available here means the receipts, right? Opening balance, cash sale, collection from debtors, proceeds from issue of shares, proceed from sale of fixed assets, other not. In any way, if you are receiving the cash, right, then you have to find out what are your going to be the cash payments during that period. You will purchase the material, you will have to pay that to the creditors, you will have to pay that, wages you have to pay, overheads you have to pay, admin expenses you have to pay, selling and distribution expenses, fixed asset you are going to purchase, other non-operating expenses. Then you will find out if there is a surplus or the shortage of cash, right? If your receipts are more than payments, you have the surplus. If your payments are more than the receipts, then there is a shortage of cash. Now, what is a master budget? Master budget is basically the complete budget incorporating each and everything. This is basically budgeted income statement is nothing but your complete cost sheet, right? There is one question in the ICI module that is related to that. You can do that, sir, right? Basically the profit and loss account, cost sheet or profit and loss account, because everything they are taking in here, sir. They are taking the amortization expenses, they are taking income tax appropriations, that what is the end profit and loss balance which will be transferred to the balance sheet. And here is the balance sheet, although balance sheet will not be asked in the examination, don't worry about it. Related to the master budget, you will only be asked the costing part, so you have to prepare the cost sheet, as there is one question in the ICI module. That is good enough. Clear? Now the control ratios. For control ratios, what you need, sir? You need basically three things, right? What is the budgeted hours? What is the budgeted hours? What are the budgeted hours? The budgeted hours means the planned hours according to the standard output, right? This is what? This is the standard hours. This is what? The standard hours for standard output. What is standard output, sir? The output that you planned for. How much of the number of units were there in your planning, that okay, we are planning to manufacture 20,000 units, but actual manufacturing can be more or less than 20,000. It can happen, sir, right? Now the second thing is the standard hours. Sir, what are the standard hours here? What do you mean by standard hours here? Please let me know what do you mean by standard hours here? The here standard hours means the standard hours for actual output, right? That for the actual output, what are the standards? These budgeted, remember the variances, sir, fixed overhead variances. The word budgeted here means for a standard output, what are the standards? The standard means for the actual output, what are the standards? The third thing that you need to find out here is the actual hours. Actual hours, right? That is the actual hours. Actual hours for actual output. Simple. Three things are required here. Then efficiency ratio. Efficiency is basically for the output that you have gained. right? What is the actual time taken and what is the standard time for that? If you are manufacturing 10,000 units, for those 10,000 units, what is the standard time? That is standard time for actual output divided by what is the actual time taken. That will give you the efficiency. Then second is the activity or the production volume ratio, right? Volume related is standard hours for actual output divided by budgeted hours into 100, right? That according to the volume, the change in the volume, what is the change in my the standards? Due to the change in the activity or due to the change in the production volume, what is the change in my standards? Clear? The third one is capacity ratio. Capacity ratio, sir, that is actual hours worked divided by budgeted hours. What is the capacity that we were planning for? What is the actual capacity that is attained into 100? Calendar ratio, here the working calendar ratio can be calculated just like as we discussed that calendar variance can be calculated if the number of days are there. So calendar ratio can be calculated if there are number of days, actual number of days divided by budgeted number of days. That will give you calendar ratio. Idle capacity ratio, budgeted capacity minus actual capacity. If your capacity is to manufacture 20,000 units, actually you are manufacturing 15,000 units. So this 5,000 is what? This is your idle capacity that you could have utilized, manufactured more number of units, sold more number of units, earned more profit, right? Or 100 minus capacity ratio, whatever is your total capacity, and this capacity ratio tells us what? That how much of the capacity you have utilized. So if from this is the total capacity, this is the utilized capacity, difference between the two will give you what? The idle capacity. Standard capacity usage ratio, that maximum possible hours in the budget period and how much is the budgeted hours. What is the maximum possible time that is that is possible in that budget period, and out of that how much of the time you are expecting to be worked, right? Then is the actual usage of maximum capacity. What is the maximum capacity and what is the actual hours that have been utilized in that maximum possible, right? So these are the control ratios. Yes, the question have been asked for 5 marks in the examination. You will have to remember these control ratios, right? Efficiency ratio, activity or production ratio, capacity ratio, calendar ratio is important, standard capacity and actual usage of maximum capacity ratio. Then just read through the theory part, and one is zero-based budgeting. This differences you can do. Zero-based budgeting, I'll give you the overview of what. Zero-based budgeting says preparing the plans or the budgets from the scratch every time. Every time, whether you are starting a new project or whether you are opening a new office, you will prepare the budgets from the scratch. Let's say you are preparing the budget for this particular year. Let's say for 23-24 you have already prepared the budgets. Now for 24-25 you will not take 23-24 as the base. No, you will do all the studies again. You will prepare the budgets from the scratch for 24-25. This is what is known as zero-based budgeting. There is no base, no previous experience, nothing. You have to start from the scratch, right? Read it here. Starts from a zero base. Every function within an organization is analyzed for the needs and cost. The budgets are then built around what is needed for the upcoming period, regardless of whether the budget is higher or lower than the previous one. We are not concerned with the previous period budget, what we have done in the previous period or what actual results were there in the previous period. We are not concerned with that. We say every time, every period, for every project, we are going to prepare the budgets from the scratch. Everything has to be fresh, every activity will be analyzed again, everything is to be done again. Okay, so let's start with illustration number 1. Let's start with illustration number 1. For my Chennai students, I will post it, might have some get together in September, but after your exams obviously, and I will be there for the whole month, almost the whole month of September, till the end of September. Okay, let's come to illustration number 1. A factory which expects to operate 7,000 hours and which is the 70% level of activity furnishes the details of expenses as under. Variable expenses are given 1260, Katiravan, for January attempt. Semi-variable expenses 1200 and fixed expenses 1800. The semi-variable expenses go up by 10% between 85 and 95% activity and by 20% above 95% activity. Prepare a flexible budget for 80, 90 and 100% activities. Now what will happen, sir? At 80% activity, you will be manufacturing 8,000 units, 8,000 hours basically, right? Here 9,000 hours and here at 100% 10,000 hours. Variable cost will change accordingly, right? So here the budgeted hours are there. Variable cost will change accordingly, sir. What is the variable cost for 7,000 units? Right? How will you calculate it? Sir, for 7,000 units, the variable cost is 1260, 7,000 hours basically. For 8,000 hours, the variable cost will be 1440. Right? Similarly, for 90%, that is 9,000 hours, and 100%, that is 10,000 hours, because the variable expenses definitely they are going to change with the level of activity. Semi-variable expenses, what is going to be there with the semi-variable expenses now? It is given that the semi-variable expenses go up by 10% between 85 and 95% activity. So at 80% activity, the semi-variable expenses are not going to change. But at 90% activity, they will increase from this level by 10%. Right? And it is given that they increase by 20% beyond 95% activity. That means at 100%, they will increase by 20%. Now this increase is to be considered from the original level of activity, that is 1200. Right? Fixed expenses are going to remain fixed. Total expenses are there, and the recovery rate, that is the expenses divided by the number of hours. Right? Now, in the conclusion, what they have written is, he says, sir, if at 7,000 units you have calculated this budgeted hours, now for 8,000 units, you cannot say that 8,000 multiplied by 0.61. The cost is 8,000 into 0.61. You cannot say the cost is 4,880, right? You cannot use this as the absorption rate for 8,000, 9,000 and 10,000 hours, because there is a variable cost also, semi-variable also, and certain fixed cost also, right? So for every cost, there will be a different rate that will be calculated. That is what is there in the conclusion. Any doubts in illustration number 1? Sure, Kathiravan. I'll inform you guys, don't worry. We will meet, and obviously you guys will have to show me some places now, because I'm coming there for the very first time. But I'm excited because that will be my first live face-to-face batch. Not live, face-to-face. Okay, any doubts in illustration number 1? This was a flexible budget being prepared at the different levels of activity. Right? Clear? Preetham says clear. Rest of the people? Clear? प्रतिमा आप एक बार व्हाट्सएप डाल दो, हमने वो पोर्टल चेंज किया है ना। प्रतिमा आप ना जो पहला पोर्टल चल रहा था उस पर नहीं चलेंगी क्लासेस, हमने ऐप चेंज की है, ठीक है। आप अगर आप iOS पे कर रहे हो ना, आप iOS पे कर रहे होगे, और आपकी आई थिंक वैसे भी एक्सपायर हो गई होगी, शायद एक्सपायर हो गई है क्या? तो डाउनलोड करके भी एक्सपायरी तो चलेगी ना, डाउनलोड करके हमेशा के लिए नहीं रहेगी प्रतिमा। यस सरी, डिफरेंट रिकवरी रेट्स फॉर ईच लेवल ऑफ एक्टिविटी। आपकी अगर एक्सपायर हो गई है क्लासेस, आप एक बार व्हाट्सएप डाल दो, ठीक है, आप ऐप अपडेट कर लो, एंड्रॉयड ऐप अपडेट करोगे तो आपको नई ऐप मिल जाएगी, वहां पे आपको एक्सटेंशन दे देंगे। इफ यू नीड इट फॉर September 24, वी विल एक्सटेंड द क्लासेस, डोंट वरी। प्रतिमा डाउनलोड करके भी एक्सपायरी तो होगी उसकी, लेक्चर्स की जो भी एक्सपायर्ड डेट है, आपने जुलाई अगस्त में आई थिंक परचेज किया होगा, तो 11 मंथ्स पे वो एक्सपायर तो हो जाएगी क्लासेस, इवन इफ डाउनलोडेड, ठीक है ना। डाउनलोड का मतलब ये नहीं है कि वो हमेशा आपके पास पड़ी हैं, डाउनलोड इज ओनली कि आप ऑफलाइन उसको कभी देखना चाहो तो देख सकते हो। एक्सपायरी होगी, इफ यू वांट एक्सटेंशन आप मैसेज डाल दो, एक बार व्हाट्सएप कर दो, एक्सटेंशन आपको मिल जाएगी, डोंट वरी, ठीक है। Okay, let's move on to the next question. So lot of in between queries today. Anyhow, illustration number 2. A department of company X attains a sale of rupees 6 lakh at 80% of the normal capacity and the expenses are given below. Administration cost is given, office salary is 90,000, general expenses 2% of the sales, so it is going to be a fixed cost for you. And general expenses are dependent upon the sales, so if the sales change, your expenses will also change now. It is a variable cost because it is dependent upon what? It is dependent upon the sales. Depreciation, it is a fixed cost for you. Rates and taxes, it is again a fixed cost for you. Selling cost, salaries 8% of the sale, traveling expenses 2%, sale office expenses 1%, general expenses 1%. All this is what? All this is your variable cost. Right, all this is what? Your variable cost. Then distribution cost is there, wages 15,000, it is going to be fixed. Rent is there, that is 1%, other expenses 4%, it is going to be variable. Prepare a flexible administration, selling and distribution cost budget operating at 90%, 100% and 110% of the normal capacity, right? So what is the normal capacity? Currently he says at 80% 6 lakh rupees is the sale. You have to prepare for 90, 100 and 110. So what will be the sales? If the sales at 80% is 6 lakh, at 90% it will be 6 lakh 75,000, at 100% it will be 7 lakh 50,000, 110% 8 lakh 75,000. Obviously the sales will change, right? Then administration cost, office expenses are fixed, general expenses are 2% of the sales, depreciation fixed, rates, rent and rate fixed. Now here one assumption that they have taken is that, sir, like office salaries, he says if you are going beyond 100%, if you are going at 110%, that is beyond your normal capacity, right, then these expenses might change, even the fixed expenses might increase. If you want to expand your capacity beyond 100%, you might have to take extra space, you might have to do some extra expenditure. But here, because there is no information regarding that, so what we are going to take is that this will remain fixed even at 110%, right? Then selling cost, all dependent upon the sales. Distribution cost, some is fixed and some is 1% of sales, 4% of sales, and the wages are there fixed, right? So total cost. Simple question, sir. Simple question. Just the calculations, that's it. Isn't it? Any doubts on this one? Very simple question. Illustration number 2. Any doubts in question number 2? Issue class के end में, at the end of the class you can ask, right? Right now we are doing budgetary. If you have a labor costing का कुछ पूछना है तो at the end of the class. Simple one है ना, part of cost sheet कह लो. Yes, we can say part of cost sheet. Okay, come to illustration number 3. Now this is a good one. Illustration number 3 is an important question, sir. What is illustration number 3 about? He says action plan manufacturers normally produce 8,000 units of their product in a month in their machine shop. For the month of January, that is, normally they manufacture 8,000 units. In the month of January, they had planned for a production of 10,000 units. Okay, that means they had the capacity. They thought, why not go for 10,000 units? They might be having some extra order also. Owing to a sudden cancellation of a contract in the middle of January, they could only produce 6,000 units in the January, sir. They planned for 10,000, but there was a cancellation of a contract because of which they could produce only 6,000 units in January. Indirect manufacturing costs are carefully planned and monitored in the machine shop, and the foreman of the shop is paid a 10% of the savings as bonus when in any month the indirect cost incurred is less than the budgeted provision. So he says whatever the indirect costs are, that is the overheads, whatever the overheads are, they are carefully planned for, and the machine shop and the foreman, they are paid the commission if the actual overheads are less than the planned overheads, right? Budgeted, if they had budgeted for 100 rupees, if actually it is 90 rupees, that means there is a savings to the company, na? So the company says, okay, the foreman or the manager, we will, of this savings, we will give you 10% of it, right, as an incentive. That is given as an incentive. The foreman has put in a claim that he should be paid a bonus of 88.50 for the month of January. Now the foreman is asking the management that management, please pay me 88.5 rupees for the month of January, and management is completely shocked. Why? The works manager wonders how anyone can claim a bonus when the company has lost a sizable contract. Works manager says, you are asking for a bonus. The company has lost a contract. The company has the company has to incur a huge loss, and you are asking for a bonus. Are you a fool? The relevant figures are as under. So indirect manufacturing expenses are given. That is, the overheads are given. Expenses for a normal month. Normal month means when they are manufacturing 8,000 units, right? Planned for January, the planning was for how many units? That is for 10,000 units. Actuals for January, the actual was for how many units? 6,000 units. So these are the overheads which are given to you. Do you agree with the works manager? Is the foreman entitled to any bonus for the performance in January? Substantiate your answer with the facts and figures. Now, what we will have to compare, sir? We will have to compare that, sir, if for 6,000 units the actuals are this, we will have to set up what? We will have to set up the budget for 6,000 units and then compare if there is any saving in the cost or not. If there is a saving, then yes, foreman will get the bonus. When is the foreman getting the bonus? He is getting the bonus if the actuals are less than the budget. Now here the actual cost is for 6,000 units, but the budgets are not for 6,000 units. We will have to create the budgets for 6,000 units, then compare it with the actual for 6,000 units and try to find out who is correct. The works manager is correct or the foreman is correct, right? Okay, now come to the salary. So I'll write here the budget for 6,000 units. How we can calculate it, sir? Salary of the foreman. Salary of foreman is 1,000 in any case. That means it is what? It is your fixed expense. So for 6,000 units, the budget will be 1,000, right? Is there any excess or something? No, sir. Nothing, right? Indirect labor. Now, indirect labor is changing, sir. 720, 900. Let's focus on these two. These two are the budgets now, sir. These two are the budgets now, but for the different units, 720 and 900. First of all, tell me, sir, this indirect labor, what is the nature of this cost? What is the nature of this overhead? Whether it is a fixed? No, sir. Fixed to hai nahi, sir. Whether it is variable or whether it is semi-variable. Please tell me the nature, or tell me how we can identify that whether the overhead is a variable or a semi-variable? Joydev says it is a variable cost. How can you say that, Joydev? How can you say that it is a variable cost? On what basis you have identified that it is a variable cost? AK, Joydev, all you are saying that, sir, it is a variable cost. I agree. I am saying, okay, it is a variable cost, but on what basis you have identified, sir, that it is a variable cost? On what basis? Per unit increasing, huh? Per unit increasing? Okay, what is the per unit? What is the per unit here? 0.09. What is the per unit here? 0.09. Shubhangi, this fast track is for 2,950, right? You can check on our website or on our mobile app. It is for 2,950, जिसमें सब कुछ included है. Okay, now listen to it. Indirect labor cost. It is per unit is same, but total cost is varying. So it is what? It is a variable cost, sir. Right? So what will be the budgets for 6,000 units? How can you find out the budget for 6,000 units now? That will be 6,000 multiplied by 0.09. 540. Sir, 540 is the budget for 6,000 units. What is the actual expenditure? That is 600 rupees. That means there is an excess of actual expenditure by 60 rupees. No saving, sir. No saving. In fact, the actual expenditure is more, right? Coming to the next one, indirect material, again a variable cost, right? So it is 0.1 and 0.1. Clear? 0.1 and 0.1, sir. So what will be for 6,000 units? It will be 600. The budget is 600. The actual expenditure is 700 rupees. So again, there is extra expenditure, no savings. Now foreman is having, he is sweating slowly. Foreman is asking for a commission on savings, and here it is coming out to be the extra expenditure. Now foreman is slowly getting back. Now repairs and maintenance. Tell me the nature of cost for repairs and maintenance. Please tell me that quickly. Quickly tell me for repairs and maintenance. Joydev, semi-variable cost. Badhiya. AK says semi-variable. So you guys are doing your work very good. Huh? You guys are working very good. Correct, sir. So it is a semi-variable cost. So how we are going to bifurcate it now? We will have to find out what is the budget for 6,000 units. Now we cannot directly calculate here, right? Why it is a semi-variable cost? 600 divided by 8,000, because the per unit cost here is 0.075 and here the per unit cost is 650 divided by 10,000, that is 0.065. Now in this case, per unit cost is also changing as well as the total cost is also changing. So it is a semi-variable cost. Now we will have to find out the budget for 6,000 units. Now we cannot calculate how we will multiply. We will multiply with 0.075 or 0.065. How can we multiply, sir? We can't. So we'll have to find out. Sir, how we will find out? For 8,000 units, what is the cost? 600. For 10,000 units, what is the cost here? 650. That means for additional 2,000 units, my additional cost is 50 rupees, right? So from here, variable cost per unit, how much will be the variable cost per unit, sir? 50 divided by 2,000, that is 0.025. So what will be? So that means out of this, some is variable, some is fixed. What is the variable part? 8000 multiplied by 0.025, that is 200. So what is the fixed part? 600 minus 200, that is 400. Clear? So fixed part. So at 6000 units, what will happen, sir? At 6000 units, variable cost will be 6000 multiplied by 0.025 and fixed cost will be 400 rupees. So 6000 multiplied by 0.025, that is 150. So total here is 550. Total here is 550. So that is going to be the budget here, 550. Now the budget was 550, the actual cost is 600. Is there any saving, guys? Correct. Is there any saving? No, sir. 50 is the extra cost that is incurred. Clear? Now, next, rates, taxes, these three are fixed. Right, these three are fixed. It is going to be 150, it is going to be 800 and it is going to be 100. Now what about the power, sir? Power, 800 divided by 8000, that is 0.1, and 875 divided by 10,000, that is 0.0875. It is again what? A semi-variable cost. So please calculate and tell me what will be the budget for power. What will be the budgeted cost for power here? I am asking you for this. Please do the calculation. Good evening, Chetna. Please do the calculation, guys. Come on, quickly let me know what is there for power. It is a semi-variable cost. Okay, now I want the figure. कोई बात नहीं चेतना, no issues. $725, is it correct? I don't know. I haven't seen the solution. So Joydev says 725. Rest of the people, is it correct? 500 is fixed. So 6000 into 0.0375. Correct, I think. 725 is then correct. Okay. So you people are saying 725. I agree to it. Again, sir, some extra cost is there. Right? Now, what about the tools consumed, sir? What about the tools consumed? 320 divided by 8000, that is 0.04. 0.04. This is your variable cost. So for 6000 multiplied by 0.04, that will be 240. Right? This is the budget and 300 is the actual cost incurred. So here it is 15 rupees and here it is 60 rupees. Nothing here. Sir, forget about savings. There is extra cost. 50 plus 15 plus 60. 285 is the extra cost that is incurred. कोई बात नहीं प्रीति, I understand. समझ गया था मैं कि थोड़ा पीछे चल रहे हो आप. कोई नहीं. It is the extra cost incurred. Sir, forget about the bonus now. No bonus to be paid. Right? So the manager is correct. The foreman is absolutely wrong. The foreman is absolutely wrong. Done? Any doubts in illustration number 3? Any doubts in illustration number 3, sir? Please let me know. Please let me know if you have any doubts in illustration number 3. Yes, the foreman cannot get bonus as all variances are adverse. Correct. All clear? Very good. And all those who are live, please like the video, guys. ऐसे मत करो. Only 15 likes, 26 viewers right now. Okay, let's move on to the next question, that is illustration number 4. Where is illustration number 4? Illustration number 4. Let's try to find out where it is. Okay, here it is, illustration number 4. Now, illustration number 4, mark it as very important. This is a good illustration, sir. This is a very good illustration. A single product company estimated its quarter-wise sales for the next year as under. That this will be the number of units that they will be selling in each quarter. The opening stock of finished goods is 6,000 units. That means here they are saying the opening stock will be 6,000 units. Okay, sir. And the company expects to maintain the opening stock and the closing stock of finished goods at 12,250 units at the end of the year. Right. So they are here expecting the closing stock to be 12,250 units. Okay, the production pattern in each quarter is based on 80% of the sales of the current quarter and 20% of the sales of the next quarter. That means how many units you produce in a particular quarter, how it is dependent upon 80% sales of the current quarter and 20% sales of the next quarter you will manufacture in this quarter, right? So if you talk about the production of quarter 1, the production of quarter 1, it will consist of two things: 80% sales of Q1 plus 20% sales of quarter number 2, right? Next, the company maintains this 20% of the sales of the next quarter as the closing stock of the current quarter. Now for every quarter, like cash budget. Now for every quarter they are keeping a closing stock also, right? What is that? That is the 20% sales of the next quarter. It is the closing stock. Okay, the opening stock of raw material in the beginning of the year is 10,000 kg. Now, till now he was talking about finished goods, sir. Till now he was talking about finished goods. Now he is going to talk about raw material, sir. He says the opening stock of raw material in the beginning of the year is 10,000 kg and the closing stock at the end of the year is required to be maintained at 5,000 kg. Okay, each unit of finished output requires 2 kg of raw material, right? The company proposes to purchase the entire annual requirement of raw material in the first 3 quarters in the proportion and prices given below, right? Whatever is the total raw material requirement, they say we will purchase it in the first 3 quarters itself. 30% in the quarter 1, 50% in quarter 2 and 20% in quarter 3, and the prices per kg. Then the value of opening stock of raw material in the beginning of the year is 20,000 rupees, right? This is the value that is given to you. You are required to prepare the following for the next quarter, for the next year quarter wise. Production budget in units, right? Sir, if you want to know the production budget quarter wise, first you should be knowing what is the total number of units you want to manufacture. Total production. What is going to be the total production, sir? What is going to be the total production? Total production. What is going to be the total production, sir? How we can find out the total production? Please tell me. How we can find out the total production, sir? इश्यू क्या है सर? हॉट्स क्वेश्चन के लिए आई से मॉड्यूल एनफ? व्हाट इज हॉट्स क्वेश्चन? What is this HOTS HOTS question? Okay, tell me how we can find out the production, sir. Anything you can find out? Sir, the production will be dependent upon your sales, isn't it? Production will be dependent upon your sales. So how many units you are going to manufacture? How will you identify that, sir? How will you identify that, sir? What is the total sales that is going to take place here? What is the total sales here? That is 30,000 plus 37,500 plus 41,250 plus 45,000. That is 1,53,750. So if you want to sell, so that means the first thing will be sales, 1,53,750. Obviously this many units you will have to manufacture, plus he says besides this you will have to keep a closing stock also, right? What is the closing stock, sir? 12,250. So if you want to keep 12,250 as a stock, obviously this 12,250 you will have to manufacture more na. So what is the number of units that you have to manufacture? That is 1,66,000. But some units are already there in the store. Opening stock, what is that? 6,000 units. So minus opening stock 6,000 units. So this is the total number of units that you will manufacture in the whole year. 1,60,000 is the number of units that you will be manufacturing in the whole year. Clear? Now we have to look at the quarter wise, sir. Let's see. This is 1,60,000 for the whole year. The total number of units to be produced in the next year. Then production budget quarter wise. Now production is dependent upon what? The sales. So we have written the sales of every quarter, the total. Now what will be the production in the current quarter? The production will be 80% sales of the current quarter. So 80% sales of the current quarter and 20% of the next quarter sales. Isn't it? So this is the total number of units that you are going to produce in the month of, in the first quarter, sorry, not month, in the first quarter. This is the number of units. Then 80% here and 20% of this. Then here 80%, here 20%. Then this 80%. But now problem is that, sir, we do not have the next quarter data. Then how to identify what will be this? How we can identify this 12,250? How we can identify the production for the next quarter? Next quarter data is not there, sir. How we can do 20% then? So what is done here is that, sir, what is the total number of units to be manufactured? The total number of units to be manufactured is 1,60,000. Out of this 1,60,000, 31,500 you will manufacture in the first quarter, 38,250 you will manufacture in the second quarter, then 42,000 in the third quarter, then 36,000 this one, then what is left? 12,250. This is basically the balancing figure now. This is basically the balancing figure of the total production. Total number of units to be produced is 1,60,000. Out of that we have produced something. Whatever is left we will manufacture in the last month, sir, in the last quarter. Clear? So this is going to be the production for the last quarter. First tell me this point is clear. This is an important point, sir. This one is important here, right? This one is important. Please let me know if this is clear. Purchase is by production, definitely. Similar in FM also, in cash budget and all that is there, na? In cash budget, in working capital it is there, yes. Good. You people are doing FM also seriously. That's good. It's good to see you people as doing FM also very good. Working capital, you people remember. There we calculate debtors and all that things, you know. Clear? Okay. Now this was the first part of the question, to calculate the production budget. Now the next question is the raw material consumption budget in quantity. Now the raw material consumption will depend upon what? The raw material consumption will depend upon the number of units to be produced. Units to be produced, right? That we have just calculated the number of units to be produced, sir, and it is given in the question that each unit of finished output requires 2 kg of raw material. Each unit of the finished output requires 2 kg. So how much of the raw material will be consumed? This multiplied by 2, multiplied by 2, multiplied by 2, multiplied by 2, this will be your consumption. 31,500 multiplied by 2, that is 63,000. 38,250 multiplied by 2, that is 76,500. 84,000. 48,250 multiplied by 2, that is 96,500. So what is the total consumption of raw material? 63, 76, 500 plus 84,000 plus 96,500, that is 3,20,000. This is the total raw material that is going to get consumed. See here, this is the raw material consumption budget. This is the raw material consumption budget in quantity. Units to be produced in each quarter. Raw material consumption is given to you that it is 2 units per 1 unit of FG. So total raw material consumption that you will get here, that is 3,20,000. Clear? This is the second budget. The third one is the raw material purchase budget in quantity and value. Sir, obviously we will have to purchase the raw material now, right? Once we have decided, now we will have to purchase the raw material. Purchase will be dependent upon what? The purchase will be dependent upon how much of the raw material you want to consume, consumption, how much of the want to keep as closing stock plus closing stock, minus if there is any raw material which is already lying, sir, minus the opening stock. This will give you the raw material purchase budget in quantity, right? Raw material required for production, add closing stock of raw material, it is given in the question. This is the total raw material required, but some raw material is already there in the store, that is 10,000. So material to be purchased is 3,15,000 only. Now, it is also given in the question that this purchase of raw material will take place in the first 3 quarters only. What is the quantity to be purchased and what is the price to be purchased? Because he is asking you for the purchase budget in quantity as well as value. If you want to calculate value, you have to divide it quarter wise then. First quarter 30%, that is of 3,15,000, 30%. What is the price? 2 rupees given amount. 3,15,000, 50% at 3 rupees, 20%, 4 rupees, 252. So this is the total value of the raw material purchase budget. Clear? So this was the raw material purchase budget in quantity as well as in value. Next is asking you for the store's ledger showing the first in first out method. Now this I'll give you as homework. Store's ledger, sir, first in first out, opening balance is there, right? For a particular like first quarter, opening balance, whatever is purchases, whatever is being consumed, consumption will take place on the FIFO basis. Then what is the balance? The closing balance of one period, the closing balance of one period will become the opening for the next period, for the next quarter, right? So please prepare this FIFO method. I'll give you as homework because we have already done in material costing. Now, yes, these budgets are related, sir. If you want to produce something, your production will depend upon what do you want to sell, right? Now, then whatever, once you have decided that what is going to be the production, accordingly you will have to decide how much of the raw material is required. Then once you have decided how much of the raw material is required, you will have to identify how much of the raw material is to be purchased. All this is interrelated, sir. All this is interrelated. While teaching budgetary also, I told you that each and every budget, all these these functional budgets, these are dependent upon each other, right? Sales budget is dependent upon the demand. Then according to the sales budget, we will manufacture. According to the manufacturer, we are going to find out what? We are going to find out how much of the raw material is going to get consumed. Then we will find out how much of the raw material is to be purchased. Any doubts in illustration number 4? Now this is a very good illustration. These kind of questions definitely come in examination in the budgetary, and since the last few attempts, institute has been asking budgetary more, right? So please do not take budgetary very lightly, sir. Budgetary is very important. Please do not take budgetary lightly. This is an important chapter. Sometimes, you know, I've seen students taking budgetary very lightly, sir. No, budgetary is important, sir. Please do not take it lightly. Chalo, illustration number 5. A company is engaged in the manufacture of specialized sub-assemblies required for certain equipment. The company envisages that in the forthcoming month, December, the sales will be in the ratio of 3:4:2 respectively of the sub-assemblies ACB, MCB and the DP. That means whenever you will be selling the product, now you will sell in a package. In a package, 3 units, 4 units and 2 units will be there. Clear? After that, the following is the schedule of components required for manufacture. Components are given, that sub-assembly ACB, MCB and DP, selling price is given to you. These three are what? These three are the finished products, right? And this is the selling price for the finished product that is given to you. Then further what is given is what are the raw material that is required for the manufacturing. These 4 are the raw materials which are required for manufacturing the finished product, right? The quantity of the raw material is given, that in the manufacturing of 1 unit of the finished product, how much of the raw material will be required. Purchase price is given for the raw material. Purchase price of raw material is given to you. Then the direct labor time and variable overheads required. Labor time and variable overheads required for each of the sub-assemblies are given to you, that how much of the labor hours will be required in manufacturing 1 unit, right? In manufacturing 1 unit, how many labor hours will be required? What will be the variable overheads that will be incurred? Direct wage rate is given to you, 5 and 4. The laborers work for 8 hours a day for 25 days in a month, right? So in 1 month, for how many hours they are working, sir? 8 into 25, that is they are working for 200 hours. One worker, each worker is working for 200 hours, sir, right? And what is the wage rate for the month that one worker will be getting? I'm talking about one worker, sir. One worker is working for 200 hours and he is being paid 5 rupees per hour. So one worker will be getting 1000 rupees, right? Each worker will be getting 1000 rupees. The opening stock of sub-assemblies and the component for December are as under. The opening stock is given to you. Sub-assembly means the finished product and the component means the raw material. Fixed overheads amount to 7,57,200 for the month and a monthly profit of 12 lakh has been set. The company is eager for a reduction of the closing inventories for the month of December for sub-assemblies and component by 10% of the quantity as compared to opening stock, right? So what is there? He says closing inventory will be closing inventory of everything for sub-assemblies also and for raw material also. Closing will be opening inventory minus 10%. Then you are required to prepare the sales budget in quantity as well as value. So what will be the sales budget in quantity as well as in the value terms? You will have to find out that, right? Let's see. Sir, now the sales are not directly given to you, isn't it? The sales are not directly given to you. What is given to you is, sir, some material cost is given, labor cost is given, variable overheads are given, right now, and all these things are given, but the quantity is not given to you. Sales is not given to you. One thing we have already studied about, sir, what? if we say the selling price per unit is given, selling price per unit is given to you 520, 500 and 350, right? Now selling price is given to you for all the three sub-assemblies. If I reduce my variable cost means direct material, direct labor and variable overheads, all the variable cost, what will I get? I will get contribution per unit. Because I have selling price per unit, I have variable cost per unit, I will get contribution per unit. Isn't it? Fine, sir. The next thing that is given to you is fixed cost. Fixed cost is given to you. How much? 7,57,200. 7,57,200. And what else is given to you? Sir, the profit is also given to you, that is 12 lakh. 12 lakh is what? Profit is also given to you. So can you tell me the total contribution from here? Can you tell me the total contribution from here? That is 12 lakh plus 7,57,200, 19,57,200. Now, if I divide this total contribution by contribution per unit, what I will get is the sales. Isn't it? I will get the sales quantity. But here is a major problem, sir. What is the problem here, sir? There is a major problem now in this. What is the major problem? The problem is, sir, this total contribution is given combined. Whereas when you calculate this contribution per unit, you will get it for three different products: ACB, MCB and DP. ACB, MCB and DP. That is the problem here. How will you divide with this now? Isn't it? How will you divide with this now? For this, he says, once you calculate the individual contribution, then calculate the contribution, which we have learned in the earlier chapters also, contribution in sales mix ratio. Contribution in sales mix ratio. Sales mix ratio is given to you. That is 3:4:2. In this ratio, calculate the contribution, take out the total contribution and then divide it. Let's see the solution now. I have given you the crux. I have given you the overall crux. Selling price is given. Material cost, now component baseboard. The baseboard is purchase price is given. One baseboard is going to be used. So for all the three products, finished goods, it is going to be 60 rupees. IC08, it is going to be 80 into 20, 2 into 20 and 2 into 20. 160, 40, 40. So 160, 40 and 40. Then IC12, what is going to be there for IC12? 4 multiplied by 12, 10 multiplied by 12 and 4 multiplied by 12. 48, 120 and 48 in the making of 1 unit of the finished product, sir. IC26, 2 multiplied by 8, 16, 6 into 8, 48, 8 into 8, 64. Right? So this is what is there, 16, 48 and 64. Then the labor cost is there. Labor cost, grade A labor, 8 into 5, 6 into 5 and 4 into 5. 16 into 4, this into 4, this into 4. You will get the labor cost for all the three products. Variable overheads are given. Total marginal cost. Total marginal means the total variable cost, which is consisting of material cost, which is consisting of the material cost, that is components, labor cost and the variable overheads. Right? So this is total marginal cost. From here you will get contribution per unit. Now what is there? Sales ratio is given to you. So you will take out contribution into sales ratio. This is the total contribution that you will get depending upon the ratio of sales. Now you have the desired contribution. This we have already calculated. Desired contribution divided by total contribution per unit. what you will get now here, from here what you will be getting, this 2100 is what? This 2100 is one particular, the total batches, because see here, the manufacturing we are doing it is in, this is one batch, this is one batch, right? So when we divide the, and 9 something, 938 or what is the contribution that we have got? 932. This 932 is the contribution of this particular batch, where this is also included, this is also included, this is also included, right? So when we divide it by 932, what we are getting is, we are getting the number of batches that we are going to manufacture, right? Which will consist of all the three components. So 2100 is the total batches, but what we require is the sales budget in quantity and value for individual product. Now, if you are going to sell 2100 batches in one batch, what is the number of units of ACB, MCB and DP in one batch? It is 3 units, 4 units and 2 units. So if you are going to sell 2100 batches, so how many units will be the sales quantity? 2100 into 4, 2100 into 2. This is the total individual quantity of the product. 2100 is what? The combined production, the combined batches. In one batch, 3 units of ACB, 4 units of MCB and 2 units of DP. Selling price is there, so you will get the sales value. First, let me know if this is clear. This is the main part of this question number 5. This is the main part of this question. Please let me know if it is clear. Quickly, rest of the part is easy then. Quickly let me know if this is clear, guys. Only then we'll move ahead. Clear? So 932 is what? It is the contribution for the combined products. So that is why this is one batch. This contribution is for one batch. This is one batch, sir. So when we divide it by one batch, now we get the total number of batches. Clear? AK, Pritam, clear. Drashti, clear. Good. Anita, clear. Okay. Now, what is the second requirement of the question? That is the production budget in quantity. Now, the production is dependent upon what? The production is dependent upon the sales, right? How much quantity you will produce, sir? That will be the sales quantity which we have just calculated, plus the closing stock minus the opening stock. This is what you will manufacture now, and the opening stock is given to you. The opening stock is given. The closing stock, what will be the closing stock? That will be opening stock minus 10%, minus 10%, minus 10%, right? Minus 10%. So sales we have calculated here. Add closing stock less opening stock. Opening stock is given, closing stock is opening stock less 10%, you will get production. प्रीति 2100 बैच इसीलिए आया क्योंकि जो ये 932 था, दिस इज द कॉन्ट्रीब्यूशन फॉर वन बैच, बिकॉज वी हैव कैलकुलेटेड 96 into 3. 3 is a part of that one batch, right? Because we are saying that this is the batch, this is one batch consisting of this part, right? So when we have multiplied it with 3, 4 and 2, we are calculating the contribution not of any one product, we are calculating the contribution of one batch. So when we divided the total contribution by contribution of one batch, what will you get? The number of batches, right? So that is why 2500 batches aaya. So production budget is done. Next is the component usage budget in quantity. Now the component usage budget is dependent upon what? It is dependent upon your production quantity, right? It is dependent upon your production quantity, and it is given in the question that in the making of 1 unit, how much of the baseboard will be used, how much of the IC08 will be used, how much of the IC12 and IC26 will be used. For 1 unit it is given. What is the number of units that you are going to produce? You have calculated, sir. So from here you can calculate the consumption budget. Baseboard is 1 for each. So this multiplied by 1. Component IC08 is 8:2:1. That is 6220 into 8. 8 is for 1 unit. 6220 units we are going to manufacture. So how many, what will be the consumption here? 6220 multiplied by 8. 8280 into 8 and 39208. Similarly for IC12 and IC26. This is the component usage budget. Now the component purchase budget in quantity. Component purchase budget is dependent upon what? The consumption, the component consumption plus whatever is the closing stock that you want to keep, minus if there is any stock that is already there in your store. Closing stock, opening stock is given to you. Closing stock will be minus 10% of it, right? That will be your closing stock minus 10%. Clear? Consumption you have already calculated, so that will be the component purchase budget. Usage calculated, sir. Opening stock is given to you and closing stock is opening stock minus 10%. So you will get the purchase quantity. Purchase price is given to you. You will get the purchase value, sir. This is the purchase budget in quantity as well as in value. The last budget is regarding the manpower budget, showing the number of workers and the amount of wages payable. So it is specifically asking you to calculate the number of workers and amount of wages. Okay, sir, fine, we'll show that. Now, what is the production? The labor cost will be dependent upon what? The labor cost will be dependent upon the number of units, right? Okay, so ACB 6220 units, and it is given in the question that in the manufacturing of 1 unit, how many labor hours will be required? 8. So total labor hours requirement you will get grade A. Similarly, grade B 16 hours will be required for 1 unit. So for total 6220 units, how many labor hours will be required? Similarly for MCB and DP, this is the total hours requirement, right? Now this is the total hours requirement. Now he says 200 hours. If you talk about grade A, sir, he says 200 hours. How many workers? 1 worker. This 200 hours is for 1 worker, sir. I have already written that, 1 worker. So if the total hours being spent here is 120 hours, so how many workers will be working? How many workers will be working in this? 1 worker is 200 hours. That comes to 576. Correct. 576 workers. That is the requirement of the question. The question says, sir, tell me how many workers are there. We say 576 workers. Now, what is the wages payable? Read the question again where I told you. Read the question part again. Where is the question part again here regarding? See here. Read this. 1 worker is equal to 200 hours and 1 worker is getting how much wages? 1000 rupees per month. This is 1 worker is getting 1000 rupees per month. So here if we say the workers part, 576 workers multiplied by 1000 rupees, this will be the total wages that will be payable, sir. 5,76,000. Similarly for grade B, 1 worker is working for 200 hours and total hours being worked is 2,30,240. So how many workers will be there? The workers will be 1152. What will be the wage rate? That is 800. So total wages payable will be this much. Let me know if you have any doubts in this one. Let me know if you have any doubts in this question. What happened today? The number of people is very less, only 16-17 people. Yesterday 25 around people, 25-30 people were there. Attendance getting lower and lower as we are nearing the completion now. Okay. All clear? Please let me know quickly about this question, illustration number 11, if you have any doubts in this. Illustration number 5, sorry, not 11. Clear? Ritika, 4 or 5 days. 30th na, maximum by 3rd of August. Maximum by 3rd of August. Right? Maximum by 3rd. Tomorrow we will be completing budgetary, and after that we are left with only service costing. That's it. Only service costing we are left with. And 3 days service costing ho jayega, sir. Right? All clear. Okay. So let's move on to illustration number 6 now. 6 is on master budget. 800 कैसे आया? कौन सा 800? Wage rate per month. Grade B का देखो ना. Okay. What is there for grade B? If you talk about grade B, one worker is working for 200 hours, right? And what is the wage rate? 4 rupees. So in 1 month, he will be getting how much? 800 rupees. This is for one worker. One worker will be working for 200 hours in a month, na? 8 hours and 25 days, total 200 hours. And what is the wage rate being paid to grade B? That is 4 rupees. So 800 for one worker. Clear? Okay. Let's move on to illustration number 6. Illustration number 6 is on the master budget. That is the complete budget incorporating each and everything. This is pretty easy. This question is pretty easy. Got it? Okay. Float glass manufacturing company requires you to prepare the master budget for the next year from the following information. The sales is given for the toughened glass, it is 6 lakh rupees, and for the bent glass, it is 2 lakh rupees. Direct material cost is 60% of the sales, right? So 60% of 8 lakh, right? That will be 4 lakh 80,000. Now, direct wages will be 20 workers at the rate of 150 per month. 20 workers multiplied by 150 multiplied by 12. So 20 multiplied by 150 multiplied by 12, that comes to 36,000 is the wage cost. Factory overheads, indirect labor, works manager rupees 500 per month. So 500 multiplied by 12, 4 men 400 per month, that is 400 multiplied by 12. Stores and spares is 2.5% on the sales, that is 2.5% of 8 lakh rupees. Then depreciation of machinery is given, light and power is given, repairs and maintenance is given, other sundries are given, that is 10% on the direct wages. Administration selling overheads is 36,000. So what is the requirement, sir? Master budget is nothing but your cost sheet, sir. Right? It is nothing but your cost sheet. So sales are given, total sales, then cost of production we are calculating, sir. Cost of production is direct material cost, direct wages are given, prime cost, then fixed factory overhead, work manager salary, foreman salary, depreciation, light and power assumed to be fixed, then variable factory overhead, stores and spares, repair, maintenance, sundry expenses, you will get the works cost. Then you will get gross profit, sir. Gross profit is sales minus the works cost, because in between there is nothing else. Add admin and selling overheads, 36,000, you will get net profit, or you can prepare it in the normal cost sheet format also. No issues in that. You can prepare in the normal cost sheet format also. No as such difficult calculations in this question. Simple. Sales minus works cost, you will get the gross profit, and after the adjustment of the administration, selling and distribution overheads, you will get the net profit. Any doubts in this? Where 10 by 2? 10 by 2, where? Ritika, which question are you talking about? 10 by 2 is where? Have we done 10 by 2 anywhere? Stores and spares, that is 2.5% on the sales. So 10 by 2 कहाँ किया? $8 lakh into 2.5%. This is 8 lakh into 2.5%, na? Works manager salary 500 per month, so 500 multiplied by 12. 500 multiplied by 12, because it is monthly given, we converted it into annually. We converted it into annually, that's it. 500 into 12 ना. 10 by 2 कहाँ से आया, मुझे ये नहीं समझ में आया. अच्छा चलो फिर ध्यान दो क्लास में. That's what I was thinking. 10 by 2 is not written anywhere in the solution also. Okay, any doubts in this question? Any doubts in illustration number 6? Please let me know quickly if you have any doubts in illustration number 6. Or we can move on to illustration number 7. All clear? Good. Let's move on to illustration number 7 now. Illustration number 7 is on ratios, performance ratios. It is on budgetary ratios. Okay, illustration number 7. Mark it as important because these ratios can be asked, and if the ratios are to be asked, this is almost the only question that can be that is there. The following data is available for DKG and company. The standard working hours are given that 8 hours per day and 5 days in a week. In 1 week they are working for 5 days and each day they are working for 8 hours. Okay, so that means if you talk about 1 week, how many hours they are working for? That is 8 hours multiplied by 5 days. They are working for 40 hours in one particular week. Right, Hari. Maximum capacity is 50 employees, but actually 40 employees are working. This is the maximum capacity that they can do, 50 employees, but under the normal conditions, actually only 40 employees are working, right? नहीं, वो नहीं करना है, business bites वो नहीं करना है, risk analysis नहीं करना आपको, skip करो. Next is the actual hours expected to be worked is 6,400 hours. The standard hours expected to be earned per 4 weeks is, and this is for the 4 weeks it is given, right? 8,000 hours. Actual hours worked in the 4 week period is 6,000. So this is what? This is the actual hours for actual output. Standard hours earned in the 4 week period is 7,000 hours. That is, this is the standard hours. Earned means for actual output. Clear? Then the related period is of 4 weeks. In this period there was one special day holiday due to the national event. Calculate the following ratios. Now what is required here, sir? We required the budgeted hours. The budgeted hours is what? The budgeted hours is actually this 6,400 hours. This is the budgeted hours. How, sir? This budgeted hours tells us what? The actual hours expected to be worked. expected to be worked, that means we were expecting that 40 employees will be there, right? 40 employees will be there, they will be working for 5 days in a week, multiplied by 8 hours per day, multiplied by 4 weeks. This is what we expected from the standard output itself, right? Actual hours expected to be worked. Sir, then what is the standard hours expected to be earned? Sir, this is the total capacity. Standard as per the actual capacity is 50 employees multiplied by 5 days multiplied by 8 hours multiplied by 4 weeks. Yes, this is what, this is your total capacity hours. This is what, this is your total capacity hours, right? This is what, this is your budgeted hours. This is your budgeted hours, this is your capacity hours, then you have the actual hours for actual output, then you have the standard hours for the actual output, right? This is what is there. So maximum capacity is 8,000 hours. Budgeted hours is that normally the 40 employees are working. This is the budget that we have set. Actual hours is 6,000 hours given. What is the standard hours for actual output? 7,000 hours. This is also given to you, right? Then what is the budgeted number of days? That is 20 days, 4 weeks into 5 days in a week. We are talking about a 4-week period, not 1 week. We are talking about 4-week period. Actual number of days is, there is a 1-day holiday, so 19 days is the actual number of days that they have worked, right? Now you can calculate all the ratios. Efficiency ratio is dependent upon what? For whatever the actual output you have manufactured, what is the standard hours and what is the actual hours? Standard hours for actual output divided by actual hours, this will give you the efficiency, sir, right? Then activity ratio. Activity ratio means the difference between the standard and the budgeted hours. That activity means the number of units. So what is the standards for standard output and what is the standards for actual output? What is the difference between, why there is a difference between the standards? Due to the activity. Activity here means the number of units being produced, right? So that will be telling us. Calendar ratio. Calendar ratio will be the available working days divided by budgeted days. That out of the total budgeted days, how many days we are actually working? 1 day is a national holiday, sir, right? 1 day is a national holiday. So next is standard capacity usage ratio. Standard capacity, that out of the maximum possible hours, what is your standards? Standard means the budgeted 6,400 hours that you are expecting to utilize out of the total capacity. Actual capacity is out of the total capacity, how much of the actual hours you have utilized, right? Actual usage of budgeted capacity, that out of your budgeted capacity, what is the actual hours that you have utilized? Out of 6,400 hours, you have actually worked for 6,000 hours. That means you are utilizing 93.75%. So these are the ratios. These are the important workings for these ratios. Now tell me if you have any doubts in this question. Illustration number 7. We are done with all the illustration part. With this illustration part is over, sir. Done. Any doubts in 7th one? Please mark it as important. Mark 7th as important. It's a good one and it has already been asked in the paper also, right? Similar kind with the changed figures only. That's it. So definitely you are expecting this. Clear? Everybody, please quickly let me know if it is clear, guys. Okay, now we'll come to the practical problems. Rest of the people, come on quickly, let me know if it is clear. All clear? Very good. Preetham says clear, AK says all clear. Good. Let's come to the practical problems now. B Limited manufactures two products X and Y and sell them through two divisions East and West. Okay. For the purpose of sales budget to the budget committee, the following information has been made available for the year 22-23. Good. The budgeted sales are given. Yes, calendar ratio only if the days are given, obviously. Budgeted sales and actual sales are given for the product X in East Division, West Division, 800 units at 18, 1200 units at 18. Actual sales are there. Then similarly for product Y in each of the divisions, what is the budgeted sales and what is the actual sales, at what rate it has taken place. Then he says the adequate market studies reveal that the product X is popular but underpriced. It is expected that if the price of X is increased by rupees 2, if it is increased by rupees 2, that is 20 plus 2, 20, right? It will have a market. It will find a ready market. On the other hand, Y is overpriced. Y is what? Y is overpriced. And if the price of Y is reduced by 2 rupees, it will have more demand in the market. So it should be reduced by 2 rupees, sir. Okay, fine, sir. Minus 2, 40, minus 2, 40. The company management has agreed for the aforesaid price changes. On the basis of these price changes and the reports of the salesmen, the following estimates have been prepared by the divisional managers. Percentage increase in the sales over the budgeted sales. So what will be the budgeted sales? New for the product X in East Division, the budgeted sales is 800. They say if you change the prices now, this 800 will increase by 12.5%. So what will be there? 800 plus 12.5%. 900 will be the East Division, right? Then in the West Division, 1200 units plus 7.5% increase, that is 1290. Similarly, for product Y, 600 units is the budgeted plus 22.5% increase, that is 735. And 1000 plus 12.5% increase, that is 1125. This is how this is happening, sir. They say if you change the prices now, the price increase by 2 rupees and decrease by 2 rupees, your sales will increase. Okay, sir. Let's see. Further, he says, with the help of intensive advertisement campaign, the following additional sales over and above the above mentioned estimates. Over and above this, there will be additional sales also if you spend some amount on advertisement. Right, what will be that? Additional sales will be 120. So 900 is already there, plus 120 will be the additional sales. 1290 is already there, plus 140 will be the additional sales. 735 is already there, plus 80 units will be the additional sale. 1125 plus 1000 additional sales will be generated. He says you are required to prepare the sales budget for 22-23 after incorporating the above estimates and also show the budgeted sales and actual sales of 21-22. Sir, budgeted sales and actual sales is this data, sir. This is the data for 21-22, right? That is, you have to show this only, nothing else. Quantity, budgeted also and actual also. So this is already provided in the question itself, right? The only thing is, for the next year, you have to incorporate the required changes and then prepare the budget. What are the changes? The first change is the quantity you will have to calculate from here. The second change will be the price. Price will be 20 rupees and 40 rupees. That's it. So a very simple, straightforward question here. See here, the statement showing the budget. Product X, product Y. For East Division, the quantity is calculated, sir. Rate now not 18 rupees, the rate will be 20 rupees. 815 and this rate will be 40 rupees, right? So they have calculated the quantities here, sir. They have calculated the quantities here multiplied by the revised rate, that will give you the budget. Quantity rate amount, that's it, right? And the budget for 21-22, it is already given, sir. Everything is given. You just have to put in the figures, that's it. The figures which are given in the question itself, you have to put it. This amount is only to be calculated. Actual sales are also given, sir. Everything is given in the question. So you don't have to put in any efforts in this particular part, isn't it? Any doubts in question number 1? The only thing is how to play with the quantity, that's it. How to calculate the quantity. Any doubts in this one? Please let me know. Any doubts in question number 1, sir? Clear? Everybody else? Quickly guys, quickly everybody. Clear, 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 clear. Okay, let's come to question number 2 now. Question number 2. Yes. Question number 2. During the financial year 21-22, P Limited has produced 60,000 units operating at 50% capacity level. The cost structure at this level is given as under. Direct material is 300 per unit, direct wages is 100 per unit, variable overheads is, variable overheads is rupees 100 per unit, direct expenses are 60 per unit, factory expenses are 25% fixed. So fixed and variable, 25% is fixed and 75% is variable. So what is the fixed part, sir? 20 rupees is fixed and 60 rupees is variable here, right? That is variable here. Next is selling and distribution expenses. This is again fixed and variable. 20% fixed, 80% is variable, right? So 32 is variable and 8 rupees is fixed here. Office and administration 100% fixed, 20 rupees. The company anticipates that in the financial year 22-23, the variable cost will go up by 20% and the fixed cost by 15%. Sir, each and every variable cost will increase by 20%, whether it is direct material, whether it is direct wages, whether it is variable overheads, whether it is the variable factory expenses, direct expenses, they are variable, sir, and the variable part of selling and distribution expenses, everything will increase by 20%. And whatever is the fixed cost, it will increase by 15%. The selling price per unit will also increase by 10% to 880. Sir, he says it will increase by 10% and after the increase, the selling price is 880. Now, can you tell me what is the existing selling price, sir? Can you tell me what is the existing selling price? Please tell me what will be the existing selling price here. He says after the increase, the selling price is to be 880. So what is the existing selling price? I want to know this. Quickly. What is the existing selling price? 800. Correct, sir. Existing selling price is 800. On this 10% increase and it is 880. Well done. Absolutely correct. Now he says prepare the budgeted profit and loss for the financial year 21-22. So in the year 21-22, this is not going to change, because this is given for which financial year? 22-23. So you have to be very careful which period it is given and which period it is being asked in the question. So in the question is asking you to calculate the profit and loss for the which year? 21-22, sir. 21-22 to simple na sir. Sales we can calculate 60,000 into 800 rupees. Right? Material cost is given, wages given, variable cost is given. Simple profit and loss as per marginal cost statement you can prepare. Very simple, sir. Calculation of budgeted profit for financial year 21-22, 60,000 units, sales per unit 800 we have calculated, direct material given, direct wages given, variable overheads given, direct expenses given, variable factory expenses, that is 75% of 80-60 rupees, variable selling and distribution expenses 80% of 40 rupees, 32 rupees, total variable cost you will get contribution less fixed cost. But please take the fixed cost very carefully. Take the fixed cost very carefully. Total fixed cost you will get the profit. Simple. The information, all the information is already given to you. You just have to put it in the statement form. The only thing the calculation was this part, the selling price of the current period, that is 21-22. This was to be calculated. Rest everything is straightforward. Right? Now the second part he says calculate the expense budget. Calculate the expense budget for the next year, that is 22-23, at 50% capacity, that is the existing, and at 60% capacity. So at 50% you are manufacturing 60,000 units. At 60% capacity you will be manufacturing 72,000 units. That is right. So you will be manufacturing how much? 72,000 units. Now what will happen to the sales? Sir, income statement की तरह बनाना है, simple. Marginal cost statement. What is the sales here? Now sales per unit is 880. 880. It is given in the question. Now we are preparing it for the next year. For the next year it is given in the question that it is 880. What will happen to variable cost, sir? Here the this material cost is 300. It will increase by 20%. Whatever this variable cost is, for each element of this variable cost, every element will increase by 20%. So you will increase it by 20%, sir. Right? You will increase every element by 20%. You will get contribution. Now fixed cost, whatever is the fixed cost, it is going to get increased by 15%. So here whatever is the fixed cost, this will get increased by 15%. Right? And it is going to remain fixed whether at 60,000 units or whether at 72,000 units. It is going to remain fixed. Total fixed cost you will get profit. The only thing is you have to incorporate the changes with regard to the selling price, variable cost and the fixed cost. The increase and decrease. Increase, it is only the increase in this particular case. Okay. Any doubts in question number 2 now? Any doubts here? Any doubts in question number 2? Quickly, let me know if you have any doubts here. This can happen, no? This can be for any years, definitely. Definitely there can be increase or decrease for any, the percentage will be given in the question, no? Increase and decrease, the percentage will be given. Hari. So you have to increase or decrease accordingly, right? Clear? Okay, let's come to question number 3 now. The last question for today, question number 3 now, sir. Question number 3. K Limited produces and markets a very popular product called X. The company is interested in presenting its budget for the second quarter of 22-23. The following information are made available for this purpose. It expects to sell 1,50,000 bags of X during the second quarter of 22-23 at a selling price of 1,200 per bag. Each bag of X requires 2.5 meter of raw material Y, 7.5 meter of raw material Z, right? And there is one more raw material that will get utilized. What is that raw material? Another raw material that is going to get utilized is the empty bag, right? Empty bag, because sir, you will put the material X in that bag na. So empty bag is what? It is also a packing material, a raw material, right? So empty bag is also going to get utilized. That is one for every bag na. One bag means one empty bag will get utilized. Stock levels are planned as below. Beginning of the quarter, opening is given, closing is given. Finished bags are given to you, raw material YZ and empty bags. That is why I told you that empty bag is what? Again, it is a raw material and you will have to maintain the quantity, the stock of that raw material, isn't it? Now, Y cost, Y is what? A raw material. It cost 160 per meter, Z cost 30 per meter and empty bag cost 110 each. So empty bag is a hidden raw material that is given. It requires 9 minutes of direct labor to produce and fill one bag of X. The labor cost is rupees 70 per hour. Okay. The variable manufacturing cost are rupees 60 per bag. Fixed manufacturing cost is 40 lakhs per quarter. Variable selling and distribution expenses are 5% of sales and the fixed administration and selling are 375 per quarter. Prepare a production budget for the said quarter in quantity. Now production budget is dependent upon what? The production budget is dependent upon the sales and it is given, sir. How will you prepare the production budget? The production budget is sales. Sales is 1,50,000, right? Plus closing stock, whatever you want to keep it in the closing inventory, right? So the closing inventory is for X, it is 33,000. So this is what you need to manufacture, sir. But when you checked, there is already an opening stock also, that is 45,000 is the opening stock. 1,83,000 minus 45,000, 1,38,000, right? 1,38,000. This is the production budget. Clear na? Then is prepare a raw material purchase budget for YZ and empty bags for the said quarter in the quantity as well as in rupees. Now, if you talk about the raw material purchase for Y and for Z and for empty bag, sir, raw material purchase will depend upon what? It will depend upon your production, right? So what is the production? Production is 1,38,000 units, 1,38,000 units, 1,38,000 units. Then what is the requirement per unit? What is the requirement per unit, sir? 2.5, 7.5 and 1. 2.5, 7.5 and 1. So that will give you what? That will give you the total requirement. Total requirement will be 1,38,000 multiplied by 2.5, that is 3,45,000. Then 1,38,000 multiplied by 7.5, that comes to 10,35,000 and 1,38,000. Now, what is the question here, sir? He is asking you for the raw material purchase budget. We have just calculated what? We have calculated only the consumption part. It is not the purchase part. This is the total requirement, total consumption, right? If I add here the closing stock, and subtract the opening stock from here, what I will get is the raw material purchase quantity, right? Raw material purchase quantity, and if I multiply it with the purchase price which is given to you, what is the purchase price that is given? That is 160, 30 and 110. 30 and 110. I will get what? I will get the RM purchase value. Clear? So will you be able to fill these gaps now? Simple. You have to fill the values now. Closing stock is given, opening stock is given, everything is given, sir. Everything is given to you. So this will give you the RM purchase value. Clear? The next part is, last part, compute the budgeted variable cost to produce 1 bag of X. What is the budgeted variable cost, sir? For 1 bag of X, what will be the variable cost? Sir, the variable cost will be the usage of the direct material. What is the direct material to be used? Y, Z and empty bag. How much to be used in 1 unit? In 1 unit of X. Finished good. That is 2.5, 7.5 and 1. What is the cost here? 160, 30 and 110. So this will be your direct material cost, that is 160 into 2.5, that is 400. 30 multiplied by 7.5, that is 225 and 110. This is the total material to be there. Then the direct labor cost will be there. What is the direct labor cost? Labor cost is given 70 rupees per hour. 70 rupees per hour. And for 1 bag, how many hours are required? 9 minutes, right? Now, what will be the labor cost then? It will be 9 minutes divided by 60 minutes multiplied by 70 rupees, right? So, 9 divided by 60 multiplied by 70, that is 10.5. Anything else given here, sir? Anything else given? Each bag requires material is taken, sir. Stock levels are planned, given. Variable cost is given 60 per bag, right? And variable cost is given to you. Variable cost 60 rupees. Variable cost is 60 rupees. So this will be the total production variable cost. 400 plus 225 plus 110 plus 10.5 plus 60, that is 805.5. Sir, now you might ask that why have we not considered, he is asking about the variable cost, and why have we not considered the variable selling and administration expenses here? Read the requirement very carefully. He is asking you to compute the budgeted variable cost to produce 1 bag of X. That means we have to take the variable cost related to production only. Related to only and only the production part. Let's see if the answer is correct. We'll just cross verify the answer once. Yes, 805.5. Done. ABC Limited is currently operating at 75% of its capacity. In the past 2 years, the level of operations were 55% and 65% respectively. Presently, the production is 75,000 units. Now, this is at 75% capacity. The company is planning for 85% capacity level during 22-23, and the cost details are as follows. Service costing नहीं, YouTube पे नहीं रहेगा. सर्विस कॉस्टिंग तो उसी में जाएगा, अपना ऑलराउंडर में ही जाएगा. So the data is given that इशू यही कर लो, जनवरी अटेम्प्ट के लिए यही चलेगा. जनवरी के लिए अलग से नहीं आएगा दोबारा से. जनवरी के लिए दिस बैच ओनली विल बी एप्लीकेबल. So the cost details are given to you at 55%, 65% and 75%. Direct material is given, direct labor is given, factory overheads are given, selling overheads are given, administrative overheads are given. The profit is estimated at 20% on sales. So you have to be very careful that whether the profit percentage is given on cost or it is given on sales. The following increases in the cost are expected during the year. Direct material increased by 8%, labor, variable factory overheads, variable selling overhead, fixed factory overhead, fixed selling overhead, administrative overheads 10. Prepare a flexible budget for the period 22-23 at 85% level of capacity. Also ascertain the profit and contribution. Now, one thing, sir. Direct material cost. Again, if you want to calculate at 85% capacity, the number of units will be how much? At 85% capacity, your number of units will be 85,000. Isn't it? Now you will have to identify all the cost. What will be the material cost at 85%? Sir, material cost is a variable cost or a fixed cost or a semi-variable cost? Sir, it is very much clearly a variable cost. Right? So we can calculate 15 lakh divided by 75,000. 20 rupees. This is 20 rupees, sir. If you talk about the material cost here, if you talk about the material cost, it will be 15 lakh. I'm calculating per unit divided by 75,000. So it is rupees 20. At the same time, he says next year when we are planning for 85% capacity, this will increase by 8%. Right? So you have to increase it by 8%, sir. So that will be 21.6. Now 21.6 at 85% capacity, that is multiplied by 85,000 units, 18,36,000. So you will get here the material cost that you will get here is 18,36,000. Clear? 18,36,000. Let's see here. Material 18,36,000. Similarly, you will calculate for labor, sir. If you talk about labor, labor is also my completely variable cost. Sir, how do we get to know whether it is a variable or fixed cost? We have already discussed about that. Just calculate the per unit cost. Calculate the per unit cost at 55%, 65% and 75%. If the per unit cost is same, the total cost is varying but the per unit cost is same, then it is a variable cost. Clear? So again you will calculate it like this. Considering the increase also, there is an increase of 5%. So you will have to do it in the same way, sir. For the labor cost, that will come to 8,92,500. Okay, if you want to, let's calculate it. What will be the labor cost, sir? Labor cost will be 7,50,000 divided by 75,000. That will be 10 rupees plus 5% increase he is saying. Right, 5% increase is saying, so 10.5 multiplied by 85,000 units, that will be 8,92,500. Clear? The next one, next is our factory overheads. This we have treated. Now factory overheads, what is the information given regarding the factory overheads? One thing is very much clearly given, that there are variable factory overheads and there are fixed factory overheads. That means these factory overheads are what? This is your semi-variable cost. Now how to bifurcate the semi-variable cost? You people know that. Will you be able to solve and calculate it for 85% capacity? The variable, okay, let's do it. Fixed factory overheads I will do it, then selling overheads I'll leave it to you guys, right? Factory overheads I'm going to do 3,10,000, 330. So at what is there regarding the factory overheads? It is a semi-variable cost. At 55,000 capacity and at 65,000 capacity, what is the units? 310 and 330. Okay, cost, sorry, 310 and 3,30,000. That means if you increase the units by 10,000, your cost increases by 20,000. So what is my variable cost per unit? My variable cost per unit is 20,000 divided by 10,000, sorry. Right, that is 2 rupees. So from here we can calculate variable cost and what is going to be the fixed cost. Variable cost is going to be 55,000 multiplied by 2. 55,000 multiplied by 2, that is 1,10,000. And what is your fixed cost in this case? The fixed cost is 3,10,000 minus 1,10,000. Correct, Joydev? Fixed cost is 2 lakh rupees. So at 85,000 units, what will happen, sir? At 85,000 units, how will you calculate? What will be your variable cost? That will be 85,000 multiplied by 2. 1,70,000 plus the fixed cost, how much? 2 lakh. So your cost will be 3,70,000. So here you will write, here you will write 3,70,000. Clear, sir? Variable factory overheads, variable selling overheads. Okay, so they have calculated fixed and variable separately. Fine, sir. Variable factory overhead 178,500 and fixed overhead to acha, there is an increase also, sir. There is an increase also which we have forgot to taken. There is an increase also of 5% and 10%, so you have to consider that also, right? 5% increase and 10% increase is to be considered, right? So here 5% increase and here 10% increase, so the fixed cost will be 2,20,000 and this will be 2.1 multiplied by, this will be 2.1, so 1,78,500. Clear? So this is to be considered, sir. Any change, any the percentage increase in the variable and fixed cost is to be considered. Similarly, you will calculate for selling overheads. And what about the administrative overheads, sir? Administrative overheads, they are not being divided into variable and fixed. So that means your administrative overheads are going to be 100% fixed. It is clearly visible from this point also that it is 100% fixed. You have to only incorporate 10% increase in this, right? So variable selling overhead, variable cost, fixed cost, they have taken, sir, total cost, add profit 20% on sales or 25% on cost, you will get the total sales, you will get the contribution or profit, sir. That is what is required. Any doubts? Please let me know if it is clear. Simple question, sir, not at all difficult. The only thing is, please do not forget to incorporate these things. That is the only important thing here. Do not forget to incorporate these things. That's what I'm saying. Calculations are too many, but otherwise easy. है ना? Calculations are too many. Spasht, very good. Okay, so let's move on to the next one, that is question number 5. Question number 5. The accountant of the manufacturing company provides you the following details for the year 21-22. Direct material cost is given, direct wages, factory overheads, fixed factory overheads and variable factory overheads. Other variable cost, other fixed cost, profit is given and the sales are given. During the year, the company manufactured 2 products A and B and the output and cost. Output is given to you, that is the number of units manufactured. Selling price is given to you, that is 2 and 3.5. Direct materials is given per unit, direct wages per unit. variable factory overhead is absorbed as a percentage of direct wages. So can you tell me what will be the absorption rate of the variable factory overheads on the basis of direct wages? Please let me know what is the absorption rate for variable factory overhead, for these, not for the fixed overheads. Please let me know. What will be the absorption rate for the variable factory overhead? The fixed factory overheads are not going to change, they are going to remain at the same level. The only thing that is going to change is the variable factory overhead. Joydev says 100%. Okay, rest of the people? What is the opinion of the rest of the people regarding this, whether we should be taking 100% or not? Come on everybody, कहाँ हो आप लोग? Pritam says 100%. Okay, good. One second, guys. ओके, क्वेश्चन ये लो, क्वेश्चन देख लो, बुक नहीं है क्या जॉयदेव? राइट, सो द एब्जॉर्प्शन रेट ऑफ द फैक्ट्री वेरिएबल फैक्ट्री ओवरहेड्स विल बी 100% because it is based on what? It is based on the direct wages. So the absorption rate will be 100%. Other variable cost has been computed for the product A and product B as 0.25 per unit and 0.30 per unit. Now next, during the next year, that is 22-23, it is expected that the demand for product A will fall by 25%. So what will be the demand for product A? Product A demand will be 2 lakh and it will fall by 25%. That means the new demand of the product A will be 1,50,000. And for the product B, it will fall by 50%. That means currently it is 1 lakh rupees. This new demand here will be 50,000. Okay, Joydev, no issues. It is decided to manufacture a further product C, the cost of which is estimated as follows. Output in the units 2 lakh, selling price is given, direct material is given, direct wages are given. It is anticipated that the other variable cost per unit will be the same as for product A. Prepare a budget to present to the management showing the current position and the position for 22-23. Comment on the comparative results. So what is the current position, sir? Current position of both the products, right? So what you have to show that what is the current position, number of units that you are selling, selling price is there, total sales you will get, material cost is there, wages are there, variable factory overheads is there. Let's talk about the current position first. Let's first talk about the current position, sir. Let's focus on this position 2021-22. What is the sale units? 2 lakh and 1 lakh. What is the total sales? That is multiplied by 2 and multiplied by 3.5. You will get the total sales. Then direct material cost per unit cost is given to you. How much? 0.5 and 0.75. So number of units you have, you can easily calculate the direct material cost. Similarly, you can calculate direct wages. Variable factory overheads is 100% of this direct wages. The absorption rate we have calculated, right? Other variable cost is given per unit. It is given per unit 0.25 and 0.30. The other variable cost, it is also given per unit. So you will get the marginal cost. Marginal cost means the total variable cost. Sales minus total variable cost, you will get contribution. From the contribution, you will subtract the fixed cost and the other fixed cost, factory fixed cost and other fixed cost. From the total you will get total fixed cost and you will get the ultimately the total profit under the current scenario. Under the current scenario, what is the total profit from the two products? Now what is going to happen next year? Next year, position for 22-23, the number of units have dropped by 25% and 50% for A and B, and there is a new product C which is being introduced. Okay sir, sales are there, fine sir. Direct material per unit cost is given, multiplied by number of units. Your material cost, wages are there, variable cost 100% of the wages that we have already calculated sir. Other variable cost for A and B it is given, and for C the information is given regarding the other variable cost. For C it is given that the other variable cost will be the same as for product A. So for product A it is 0.25 now, for product A it is 0.25. So for product C also it is going to be 0.25. Not in the total value terms but in the per unit value terms. Subtracting the fixed cost you will get the profit sir, that in the year 22-23 by adding a new product we will get the additional profit. Introduction of product C is likely to increase the profit by 10,000 in the 22-23 as compared to 21-22. Therefore, introduction of product C is recommended. Any doubts in this question? Any doubts? Any doubts in this question? No doubts? Clear? Okay, then we'll move on to the next question then. Yes, not difficult, but only thing is the concentration is required, that we should not be missing out on any information that is given, isn't it? We should not be missing out on the information that is given. That's the only important thing. Let's come to question number 6 now. Mark this question number 6 as important, right? TQM Limited has furnished the following information for the month ending 30th of June. Master budget says that we will be producing and selling 80,000 units, but actually you were able to make only 72,000 units. Okay, sir. Accordingly, the sales that were budgeted were 3,20,000, but actual sales were 2,80,000 only. Okay, sir. Similarly, direct material cost, direct wages, variable overhead, fixed overheads, and the total cost. He says, then the standard cost of the product are as follows. Direct material cost 1 kg at the rate of rupees 1 per kg, right? Direct wages 1 hour at the rate of 1.5, variable overheads 1 hour at the rate of 0.5. So per unit cost is given. This is the standard cost. This is what the standard cost. Suresh, you can drop an email at ksjteaching@gmail.com. Right? Actual results for the month showed that 78,400 kg of the material were used. This is what? This is the actual quantity of material that is given to you, and 70,400 labor hours were recorded. That is the actual hours which are given to you. Required, prepare a flexible budget for the month and compare with the actual results. Now, sir, the first and the foremost thing, what is the actual quantity that you have manufactured? 72,000. Here in the question, the standards are given, or the budgets are given for 80,000 units. Now, can you compare these two things? No, you cannot compare these two things. What you will have to do is, you will have to first calculate the standards for 72,000 units and then compare those standards with the actuals of 72,000 and find out, sir, these variances are not correct. These variances are based on the standards of 80,000 and the actuals of 72,000. We cannot compare it. We will have to calculate the standards of 72,000, then the comparison is there. Clear? So let's see, sir, how the standards have been calculated. Let's see. See, master budget 80,000 units. Sales are given 3,20,000. What is the per unit sale? 4 rupees. Now we want to calculate what is the sales value as per the planning. As per the planning, the sales per unit is 4 rupees. So for 72,000 units, that is the actual output. What should have been the sales value? 72,000 into 4, 2,88,000. But for those 72,000 units, what is the actual sales value? That is 2,80,000. This is the actual sales value, right? So the variance is 8,000 adverse. Obviously it is adverse now. As per the planning, for the actual output of 72,000, you should have got the sales of 2,88,000, but you are getting a sales of 2,80,000. What is the rate here? Divided by 72,000. So you are here getting a rate of 3.89. It is less than the expectation, so it is an adverse figure. Direct material cost, total cost given is 80,000 for 80,000 units. That is 1 rupee per unit. So for 72,000 units, the cost should have been 72,000. What is the actual cost? Actual cost is 73,600, more than the budgeted. Again an adverse figure of 1,600. Again an adverse figure of 1,600. Now we are comparing. This is what? These are the standards for actual output. These are the standards for actual output, right? Then direct wages are there. Direct wages similarly 1,20,000 for how many units? For 80,000 units. So that is the rate per unit is 1.5. So for 72,000 units, what should have been the labor cost? क्या होना चाहिए था? 1,08,000. But what is the actual cost? 1,04,800. Great, sir. Here we are into favorable figures. 3,200 favorable. Some relief. Similarly, for variable overheads, we are calculating, sir, 40,000 for 80,000, that is 0.5. So for 72,000, it should be 36,000, but the actual overheads is 37,600, again 1,600 adverse, right? Total variable cost contribution they have calculated, and fixed cost, sir, fixed cost is, it should have been 40,000 now. It should have been 40,000 because fixed cost should have remained fixed at 72,000 units also, at 80,000 units also, but actual fixed cost is 39,200, so 800 favorable. These are the correct variances now, right? These are the correct variances. The net effect is 7,200 adverse. This is the net impact of all this. 7,200 adverse. This is the budget which was required, right? Flexible budget in comparison with actual, then calculating the variances, where the variances. That is what the first part of the question says. Is it clear? First, let me know if the first part is clear. Then second part is about calculating the variances, sir, material variance, labor variance. That I will give you as homework. That I will give you as homework, sir. मजा आएगा sir, homework करके. First, let me know if the first part is clear, sir. If the first part is clear. First part is clear, absolutely. Himanshu says clear, Pritam says clear. Everybody, rest of the guys, please let me know quickly. Now, in the second part, what they are asking is, they are asking you to calculate the variances. He says, calculate material, labor, sales price, variable overhead and the fixed overhead, expenditure variances and sales volume, profit variance. Right? So this will be your homework. I will show you, just once I'll show you that how we can prepare the material table, sir. Material table we can prepare, sir. If we talk about material variance, rest of the part I'll give you as homework. I want you people to just apply mind, try it on your own. So standard quantity for actual output, right? Standard rate, standard cost. Then we have actual quantity, actual rate and actual cost, right? So what is the standard cost for actual output? What is the standard cost for actual output, sir? For actual output, the standard cost is 72,000. What is the standard rate? Standard rate is 1 rupee. This is 72,000, right? So what is the standard quantity for actual output? 72,000, sir. Isn't it? This we have calculated, sir. Standard cost for the actual output of 72,000. Standard rate, we know 1 rupee it is there. Right? So what will be the standard quantity for actual output? What is the actual quantity now? What is the actual quantity? Actual quantity is given in the question. 78,400 kg. 78,400 kg. Right? And what is the actual cost? Actual cost is 73,600. So what will be the actual rate divided by 78,400? So the actual rate will be 0.939 or 8. This is how the material variance you can calculate. Similarly, from here you can calculate the material variance now. Similarly, labor variance is there. Clear? Similarly, the labor variance you can easily calculate. Will you be able to do it? Will you try it on your own once? Will you try it on your own once? Now sales variance is simple, sir. He is asking you about the sales price variance only. That is the difference between the standard rate and the actual rate multiplied by actual quantity. Actual quantity is 72,000. Standard rate is 4 rupees. Right? Actual rate we have calculated, sir. Actual rate 3.89 we have calculated. Joydev, where? The fixed part where? Where is the fixed, please specify, Joydev, fixed part where? You're talking about the fixed overheads. No, Joydev, you are saying that here it should be 30,500. Right? Here it should, you are saying 30,500. Here the fixed cost should not be changing now. Whether you are manufacturing 80,000 or 75,000, it should not be changing. Your total fixed cost should remain same. Isn't it? That is what is the nature of fixed cost. It is 40,000 at 80,000 units. So even if you are getting 72,000 units, you should be getting what? You should be getting 40,000 only. But actually there is 39,200. Clear? We will not calculate this 30,500. Sir, we are not changing it according to per unit. It should be remaining same. Right? So second part, will you people be able to do it? Please let me know quickly, guys. Whether second part you people want to try. And Joydev, is it clear? Got it? Everybody else, second part, please confirm about second part, guys, quickly. Second part, will you people try? Yes. What about rest of the guys? Preetham says yes. Joydev says yes. Rest of the people, please confirm. Okay. So everybody says yes. Let's move on to question number 7 then. If there is any issue, we can take up later on. We can take up tomorrow at the end, right? But please do try it on your own once. How to solve it? The material variances, the table I have prepared. In the similar way, you can prepare the labor variances also. Jigyasa Limited is drawing a production plan for its two products, Minimax and Heavy High. For the year 22-23, the company's policy is to hold closing stock of finished goods at 25% of the anticipated volume of the sales of the next month. Right? So he says the closing stock of any month is what? The closing stock is 25% of the sales of the succeeding month. Succeeding here means the next month. Right? Sales variance otherwise is not there. Sales variance otherwise in syllabus is not there. So the chances of asking the sales variance will be very less. It used to be there earlier. The following are the estimated data for the two products, Minimax and Heavy High. The budgeted production is given 1,80,000, 1,20,000. Direct material cost per unit is given, labor cost is given, and manufacturing overheads are given. The estimated units to be sold in the first 4 months of the year 22-23 are as under. So individually, month wise, how many units you are expecting to sell, right? That is given. April, May, June and July, Minimax and Heavy High, right? Prepare a production budget for the first quarter in the month wise. So production budget is what, sir? The production is dependent upon what? The production is dependent upon your sales. That means we are going to use this information, isn't it? We are going to use this information now for the production budget, right? So what is the individual month-wise sales that is there? Let's see. Production budget for Minimax and Heavy High. Sales are given to you for every month, right? Now, what will be the closing stock? Closing stock is 25% of the next month sales. So next month sale here is 10,000. 25% of it, we will keep it in the April as a closing stock, sir. Right? Similarly, 12,000. Right? So 25% of it, we will keep it in May. And for July also the information is given, I guess. For July it is given. 16,000 is given. Right? So for July it is 16,000. So this will be 25% of 16,000. Clear? So this is there, sir. Now, next, what will happen, sir? The closing stock of 1 month will become the opening stock of the next month, right? So the closing stock of April will be the opening stock of the month of May. The closing stock of May will be the opening stock of June. The problem is where, sir? The problem is how to calculate the opening stock of April. Will there be any opening stock of April? Yes, sir. What will be that? Sir, opening stock of April, I can call it as the opening stock of April is equal to closing stock of March. I can call this as, isn't it? I can say that opening stock of April is equivalent to what? The opening stock of April is equivalent to the closing stock of March, right? And what is the closing stock of March? Closing stock of March is 25% of the sales of the next month. What is the next month? So 25% of the sales of April. So this opening stock of April will be equivalent to the 25% sales of April, right? So that is what is there, sir. That is what is there. It is equivalent to the 25% sales of this, of the same month. That will be your opening stock. This is the point in this question. Rest is simple. Then production budget, production cost budget they have prepared. Direct material cost is there, right? Number of units 32,000 and 25,000. Per unit cost is there, right? 32,000 and 25,000 we have calculated here. So per unit is there. Direct labor cost, manufacturing overheads they have distributed on the basis of this number of this. That 4 lakh is for 1,80,000 units. So calculate the per unit manufacturing overheads multiplied by the number of units. That will give you the total production cost budget. This point is important here. Calculation of opening stock. This is the important point in this question. Please let me know any doubts in this. In question number 7, if you have any doubts. The only point was how to find out the opening stock of April. That is where we get the confusion, sir. Whether it is missing or something, or the question is wrong. But the question is not wrong. Clear? Question number 7. Joydev, see, we want to calculate the opening stock of April. I can say the opening stock of April is equal to closing stock of March. That is fine, na? Opening stock of April is equal to closing stock of March. What is the closing stock now? What is the closing stock of March? It is given that closing stock is equal to 25% sales of the next month. What is the next month to March? That is April. Isn't it? That is April. So 25% of the sales of April. So the opening stock of April will be equivalent to what? 25% of the sales of April. Joydev, clear hai? It is about whatever the information is given, the interpretation of that information. Simple. Joydev, please confirm once if it is clear, so we can move ahead. Got it? Okay, great. So we will move on to the last question. Last question, that is question number 8. That is question number 8, sir. Concord Limited manufactures 2 products using 2 types of material and 1 grade of labor. Shown below is an extract from the company's working papers for the next month budget. Product A, product B is given. The budgeted sales are given in units. Budgeted material consumption per unit in kg is given. Material X, material Y. And the standard labor as allowed per unit of the product is given to you. Fine, sir. Material X, material Y cost 4 and 6 rupees and the laborers are paid rupees 25 per hour. The overtime premium is paid 50% and is payable if the worker works for more than 40 hours in a week. There are 180 direct workers. The target productivity ratio or the efficiency ratio for the productive hours worked by the direct labor is actually manufacturing the products is 80%. So he says whatever is the productive hours now, in those productive hours, the efficiency that is achieved by the workers is 80%, sir. Right? In addition to this, In addition, the non-productive downtime is 20% of the productive hours. So whatever is the productive hours, in that first the efficiency is 80%. Whatever the number of units that you are making or whatever the number of hours they are working, that is 80% of productive hours, right? What he is saying is that working hours, actual efficient working hours. What are the actual efficient working hours? That is 80% of productive hours. 80% of what? 80% of productive hours, right? And whatever is this productive hour, in this there is a non-productive downtime also, that is 20%. 20% non-productive downtime, right? There are 5 days week, right? Each week consists of 5 days and there are 4 weeks that he is talking about. Okay, sir. In the budget period, and it is anticipated that the sales and production will occur evenly throughout the whole period. Stock at the beginning is given to you, stock at the closing stock is given, productive 4 day sales. Whatever is the total sales that you are going in the whole period. What is the whole period, sir? The whole period is 5 days in 1 week multiplied by 4 weeks. That is total 20 days in the budget period, sir, right? What will be the closing stock? The closing stock will be 4 days sales. Similarly, for product B, material X 10 day consumption and material Y 6 days consumption. Where stock can also be given as a percentage of production or purchases of a particular month. Definitely. Okay, in the question you are talking about. Calculate the material purchase budget. How will you decide what is the material to be purchased? It will be dependent upon your production. And the wages budget for the direct workers, showing the quantities and value for the month. So first you will have to find out what is the number of units that you want to produce, isn't it? Because the material purchase will depend upon what? The material purchase will depend upon your production, right? So what will be the production, sir? Production will depend upon the sales. So sales, opening stock and closing stock of the finished goods, that will give you what? The production. Let's see for the last question. Okay, so what is the budgeted sales? We have calculated, sir. Add closing stock. What is the closing stock of A and B here? Closing stock is 4 days sales. Sir, you are going to sell 2400 units in how many days? In 1 month, or in the period, sorry, in the budget period, that is consisting of 20 days, right? So in 20 days, you are going to sell 2400 units. So what is going to be for 4 days? Right? What is going to be there for 4 days? That is what is there. 2400 divided by 20 into 4. Similarly, 3600 by 20 into 5 days. That will give you the closing stock. Opening stock is given, you will get production. Now, raw material will be purchased according to this production, right? So, raw material purchase budget in quantity as well as in value. Sir, material required. How much of the material required is there? In the making of 1 unit, it is given 5 and 3, 4 and 6. So, if you want to manufacture 2480 units into 5 kg, 2480 units into 4 kg, right? And product B, 4300 3 kg, 4300 6 kg. This is the total raw material required for consumption. Add closing stock. Sir, this material is going to get consumed in how many days? 20 days, isn't it? So he says if this material is going to get consumed in 20 days, so what will be the material consumption for 10 days? That much consumption you will be keeping in the closing stock, sir. Here 6 days is there instead of 10 days. Then opening stock is given, quantity to be purchased, rate is given to you, so the total cost you will get. This is the material purchase budget. So for the purchases, first we have calculated the production, right? How many units to be produced for the production, what is required, the sales are required. And again, this calculation is important, calculating the closing stock here, right? Closing stock here it is given. If you see here, material X 10 days consumption. So we have calculated that this 25,300, it is going to get consumed in how many days? In 20 days. So what is the stock that will get consumed in 10 days? That much of the stock we will be keeping in the closing. Please let me know if it is clear. The material part is clear. Then we will move on to the labor part. Please let me know if the material part is clear. Then we will move on to the labor part, the last part. Quickly, let me know about the material part if material part is clear. So we'll move on to the labor part. Clear? Preetham says clear, Joydev says clear, rest, Drashti says clear. Okay, so now moving on to the labor part. If you have any doubts, please drop in. Wages budget. For the wages budget, what we need to calculate? We need to calculate the hours for which the wages to be paid. The wage rate is given to you. There is no doubt about the wage rate now. What is given regarding the wage rate? He says wages are paid at 25 per hour and the overtime is also paid at 50% premium. If the worker works for more than 40 hours in a week, there are 180 direct workers. So overtime is paid over and above something, right? Let's see, units to be produced, standard hours allowed per unit, that is there 3 and 5. It is given in the question that in the making of 1 unit, how many labor hours will be required? 3 hours and 5 hours will be required, given in the question. So how many total hours will be required? 7440 and 21,500. Right? Now listen to it very carefully. That's what I told you. Sir, these hours are required to manufacture 3480 units, right? Now these hours are achieved at how much efficiency? That is 80% efficiency, right? These many hours are the productive hours during which you have done the production, but this is at 80% efficiency, right? So what will be the productive hours? Sir, we say here I have written now, somewhere I have written. So this is at 7440 is equal to 80% of productive hours, right? So what will be the productive hours here, sir? That will be 7440 divided by 80%. That will give me the total productive hours to be paid. Right? The payment is not to be done for only 7440 hours. The payment is to be done for the productive hours. Even if they are working at less than efficiency, that can be for other reasons. But the payment is to be done, na, sir. The payment is to be done. Right? The payment is to be done. So 9300 is the productive hours required for production. And in addition, he says there will be the non-productive downtime also, that is 20% of the productive hours, 1860 hours. So total hours to be paid is 9300 plus 1860, total 11160. This is the total hours to be paid, right? Similarly, for product B, 21,500 standard hours at 80% efficiency. So what will be the total productive hours for which the payment is to be done? Clear? For the non-productive downtime, there is 20% non-productive downtime also. So 5375 hours is the non-productive downtime. So total hours to be paid is 32,250. Total hours to be paid 43,410. Now we need to identify whether all these hours to be paid at the normal rate or there is any overtime to be paid also. That is also to be identified. So for the normal rate, how many hours are allowed? 4 weeks, 40 hours per week into 180 workers. total 28,800 hours are allowed for the normal wages, right? Are allowed for the normal wages. That means out of this 28,800 hours, 80-20 समझ में नहीं आया? समझा देता हूँ अभी, जॉयदेव 2 मिनट रुको. Out of 43,410 hours, total hours to be paid, 28,800 hours to be paid at the normal rate. At the normal rate, right? The remaining 14,610 hours will be paid at normal rate plus overtime premium. What is the normal rate? That is 25 plus what is the overtime premium? That is 50% of 25. Right? That is 25 plus 12.5, that is 37.5. Clear? So 28,800 hours at 25, 14,610 hours at 37.5. This is the total wages to be paid here. Okay, listen to it carefully again, Joydev. 80% is what? He says whatever is the actual hours. To manufacture 2480, what is the actual hours that have been utilized? That is 7440 na? This is the number of hours which have been utilized for manufacturing 2480 units, right? Now these number of hours are what? These number of hours are achieved at 80% efficiency. It is given in the question. It is given in the question. He says the target productivity ratio or efficiency ratio for the productive hours worked by direct workers in actually manufacturing is 80%. That whatever they are spending the time in actual manufacturing, so actual manufacturing is 2480, the actual time spent on that is 7440, but this is what? This is 9330 is 100% efficiency. This 7440 is what? This is 80% efficiency, but we are not paying for this 80% efficiency na. Right? We have to pay for all the hours. Why the efficiency is less, sir? The efficiency can be less for any reason. Right? The efficiency can be less for any reason, sir. It can be due to some normal reason. The payment is to be made to the worker. Now, the worker is giving his best. Thank you, Ishika. Thank you so much. Clear, Joydev? Rest of the people, any doubts in this part? Now this is a very important part. The wages part is important in this question. The wages part is important in this question. Please let me know if you have any doubts in this. Thank you so much, Ishika. Thank you. Blessings to you also. And just keep sharing with everybody, right? Just keep sharing with all your friends, all your juniors, wherever you can share. 11,160 देखो 120% तो नहीं होगा जॉयदेव, उसमें यह है कि 20% का नॉन प्रोडक्टिव टाइम है जिसके लिए पेमेंट करनी है हमें, ठीक है ना? आप चाहे उसको 120% मान लो, 20% का नॉन प्रोडक्टिव टाइम है बट पेमेंट वर्कर को पेमेंट करनी है हमें वो, ठीक है ना? तो इसीलिए हमने कहा कि सर उसको 120% एफिशिएंसी नहीं कह सकते क्योंकि वो नॉन प्रोडक्टिव टाइम है, ठीक है? Any doubts in any of the questions or this question, any point, any doubt? So with this we are done with the budgetary part and